there's a lot of conversation, of course, even last week about whether or not the banks were doing the Fed's job for them. And given the fact that this is perhaps the most telegraphed recession, as some have called it, that we're heading towards, what should we make of the bank turmoil that's continued to take place, and how much that either worsens the projections for a shallow or mild or even severe recession?
Good morning, Brad. This is the problem with banking crises. And I would say, fortunately, it does seem to be relatively constrained so far. But, unfortunately, as we learned in prior crises, these things have a way of metastasizing over time. So as of now, yes, to a certain extent, this does do the Fed some favors in terms of taking some liquidity out of the system, but not in a good way. First of all, you have all this nervousness of bank accounts. Fortunately, not all the bank accounts were wiped out. That would have been extraordinarily deflationary and had terrible knock-on effects. And it will be up to policymakers to figure out what is the right thing to do going forward. But I understand why they did triage when they did. You still had bondholders and stockholders in these companies largely wiped out, and that's a big diminution of of wealth out there, not always equally distributed in that sense, because it's not everyone who holds it. But the other problem you're having is just sort of the gears grinding as people sort of get nervous and move their money from point A to point B. That's kind of a neutral in terms of where the Fed goes. I think it did some of the work for them, but not in the way they want to. It doesn't really attack inflationary expectations. It doesn't. It's the balance sheet. Their balance sheet grew even as they're doing quantitative tightening. You can argue it was temporary measures of banks depositing money at the Fed, but it's a very uneven way. And if you ask them if this is the way they want their job done, they will pretty much uniformly say not a chance.
Well, I don't know if there's any ideal when it comes to the Fed, right, in terms of how they want to do their job. We heard from Neil Kashkari speaking yesterday, and he said we are closer to a recession potentially because of everything that's happened. Is that a signal to the markets that the Fed might be done after this? I mean, that's not what the market is pricing in right now.
It's not. And, you still had Bullard last week raising his price target, his peak rate target to about 5 5/8. You still have Kashkari who acknowledges his is around 5 3/8 or something of that nature. So it's not clear that they're ready to call it on inflation yet. This is really the conundrum that markets have. And stock markets, I think, at some level are just sort of choosing to whistle past the negative alternatives. Couple things here. Number one, peak rates do not equal pause. Peak and pause do not equal pivot. We've seen plenty of historical precedents for the Fed raising rates and leaving them there. So there's nothing to say that once this peak rate is reached, whether it's next meeting, the following meeting, or sometime thereafter, that they're going to just turn around and say, okay, yeah, we won on inflation. This is fabulous. Let's just turn around, job done, pat everybody on the back, and start cutting rates. So if you're banking on a rate cut, it's going to have to be for something else. It's going to have to be because of inflation or because of some other recessionary, because of recession or some other force that forces their hand. And none of those are particularly market friendly. So be very careful what you wish for here. And that's kind of the issue at what point is the Fed's job done? I think because they left their foot on the accelerator for too long. My guess is they're going to be inclined to leave it on the brake for too long, unless, of course, there's an accident, and you really shouldn't be hoping for that.
So what are the best parts of the market to be in, as the Fed is very clear about making sure that they achieve their dual mandate, but at the same time, investors just trying to figure out how they can best anticipate the Fed's actions?
This is an interesting one because, right now, I see it as almost a generational shift. Is the people who've been through 2008 and prior, in other words, us older folks, know that these things can unravel in a very inopportune way and over time. I think that anyone sort of 40 and under has only ever seen a Fed that's willing to just jump in and protect the stock market. Remember, Now, that's not always actually what the Fed is doing. They're actually, when they do jump in, the quote unquote Fed put, I'll argue has nothing to do with stocks. But the stock market reflects what's going on elsewhere. And so you've either been conditioned to buy every dip because the Fed is going to come to the rescue, or you've seen this movie before and say this doesn't end well. And I think you've got this real push and pull within the markets between two different camps of investors. It's not clear who's right now. Although the one thing that does worry me is sort of the concentration in everybody's favorite stocks, so to speak. You've got now Apple and Microsoft combining to be 25% of the NASDAQ 100. Stop and let that sink in. Two stocks being 25% of a major index. 13% of the S&P 500, give or take, combined. And so I think the idea of just buying, you have to be much more selective and a little more risk averse, I think, than the markets are intending to do. But it doesn't mean you just have to run for the hills either.
Yeah, I mean, Steve, I'm over 40. I remember the financial crisis. I wasn't trading it. I was reporting on it. But, can't there be a way that's neither of those? And I guess that's kind of the scenario you're painting. In other words, is there imminent disaster? Is the banking system going to collapse? Doesn't feel like it. Should you go in here and buy like crazy? Maybe not. But, isn't there a third way, which is kind of what you're describing, that you just go in and kind of pick and choose here?
Well, I think that's it. I think selectivity is important. I think being nimble is important. I think not being wedded to one, to one investment dogma, so to speak, is very important. And that's really the key. But I think you have to back up and say, what are your assumptions? Am I essentially betting on some, 3-team parlay to come through that we won't get a banking crisis and we'll win on inflation and we won't get a recession? If that's your base case, think about that, because a lot has to go right. If your base case is we won't have a banking crisis and the Fed may back off a little bit and we may get a mild recession, well, that's something different. So just go through your scenarios and put a probability on each of these things. I think right now the banking crisis probability certainly feels a lot less than it was a couple of weeks ago. I think, each of these banks had a specific problem. In the case of Credit Suisse, one that had been building for years. So maybe it won't be as contagious as it was before. We certainly hope not. But I think you have to really think through the scenarios of what do I expect happening? Am I implicitly banking on a good economy? Am I implicitly banking on recession? Am I implicitly banking on investing based on rate cuts? And if so, what's going to cause those rate cuts? So you have to work through all these details, I think, to get to the bottom line of what you should be doing. And that's not necessarily the same thing for every person.
Steve, I certainly hope that you weren't banking on a 3-team parlay after watching March Madness this weekend, because that wasn't it.
I live in Connecticut, so that's been my team.
You're riding high right now. Love it.
All right,
exactly.
Steve Sosnick, good to see you. Interactive Brokers Chief Strategist. Thanks a lot.